Hello value investors, thank you for joining me. My name is Michael from Deep Value Returns on Seeking Alpha. I want to talk to you today about PayPal. So PayPal's just announced its Q2 results and its guidance leaves something to be desired. That's at least on the surface. But as we go through it, I think that you'll find ample reasons to be quite compelled about this investment. So let's dig into this, right? So let's add a bit of context here. So if you remember, since May, PayPal has just been on a rocket. And with that in mind, there's just so much high expectations. Remember, PayPal is a fully entrenched payment solution provider. And in fintech, there was just this buzz around how the company is going to perform. And remember that if you look back to Q1 of this year, PayPal has just reported its strongest revenue growth rates in its history. So it has grown quite substantially. So the expectation was that it was just going to totally just beat this Q2 result. And anytime that if you compare with the rest of the market, many names in tech right now are firmly into correction territory. That means they've actually sold off by at least 20%. So in that light, expectations are really, really high. So any mishaps and the stock would have been primed to sell off. So as you can see here, the guidance for Q3 is for 14% year-over-year growth rate. So why is the growth rate for Q3 so much weaker than it is compared to last year? So the big takeaway here is that eBay Marketplaces is migrating off to eBay Marketplaces will no longer be using PayPal. They'll use their own services, and this is causing a meaningful headwind. Okay, so what PayPal is saying that if you compare with the benefit that they had last year during the COVID period from eBay, and now that eBay is actually leaving PayPal, there's a slight dislodging, and it's slightly abnormal going into Q3, but once Q4 comes around, the impact of eBay is going to be reduced further, and start in 2022, which is in 6 months' time, that eBay is totally off the platform, and you're going to have a much cleaner company. And PayPal, I suspect, is probably going to be growing back at mid-25, maybe mid-20s compounded annual revenue growth rate. So it's a company that's right now expected to grow 20%, but as it comes out to next year and it hasn't got this headwind from eBay, it's going to be actually growing faster. So you can see here that PayPal's CFO noting that last year PayPal grew at 22% year over year, but that it had approximately 5 percentage points from benefit from eBay, and that right now they grew at 19%, but they actually had a headwind of 8%. So it clearly shows you that the company, excluding eBay's impact, is very, very strong indeed. They say that excluding eBay's impact, this quarter would have grown at 32% year over year. That's a very strong performance right there. So management's been very honest and saying, okay, we had some impact here, but next year this is not going to be an issue. And if you think about it, they've got so many cool products with PayPal. They've got this Zettle, which is like a competitor to Square, and it's just a card payment solution. So it's an ability for merchants to transact offline as well as online. So that's one of the products quite compelling. Obviously, the rage everywhere, buy now, pay later, that's resonating very strongly with consumers, and sequentially it's actually up 50%. So PayPal's buy now, pay later, the digital wallet is performing strongly. Zettle's coming on the scene in the US. So there's just a very broad array of products here that I think that it just solidifies their position in this payment space. And what's more, PayPal is still saying, okay, so even if you think about it, even though free cash flow was slightly negative, it was negative 33% year over year, they're still guiding for that 5 billion marker. So they're saying that in 2021, despite eBay's impact, we're still going to generate 5 billion of free cash flow. That's very, very strong amount of free cash flow, and that puts the stock trading right now at 74 times free cash flow. Now, you're going to say, okay, 74 times free cash flow, that's really expensive, Michael. That's not really that attractive for a company that is growing at approximately 25% next year. On the surface, that's true. But you have to remember that so many other companies are actually not generating that strong free cash flow in fintech. So here's a company that's growing at approximately mid-20s, and on a sales multiple, it's priced at just 13 times sales, this year's sales in 2021. So at 13 times sales, not many companies out there that are growing at mid-20s, priced at 13 times sales, generating strong free cash flow. So altogether, I think that there's a lot here to for investors to be attracted to. For me though, I prefer to pick out small cap names, and right now many small cap names are firmly into correction territory. So there are other names that I'm much more attracted to right now, and if you want to find out some of these names, check out my marketplace. It's called Deep Value Returns. You're welcome to do a totally free trial to see if it suits you, and you can cancel anytime before 14 days. And I'm not a place to replace you. I'm just giving some ideas for you to say, okay, these are the stocks that I'm investing, and it's just a source of ideas. So you really have no excuse not to give it a shot. So in any case, I hope to see you soon, and if not, I'll see you next time.